Welcome back. In today's video, I'm going to talk about why the Bank of Canada has been lowering its interest rates over the last little while and who it helps and who it doesn't help, essentially. So first, why does the Bank of Canada lower and increase interest rates? Basically, it's to try and control inflation. Pre-COVID, we saw inflation stay fairly low for quite a long time, and that led to the Bank of Canada's interest rates being low for quite a long time, and that made borrowing money quite cheap, and really is one of the reasons that I think is responsible for the housing prices getting out of control in the last little while. And then when COVID did happen and there was lockdowns and governments around the world gave people money to help them through this difficult time, people had a lot of disposable income when things started opening up. That and the fact that there was a shortage of just about everything led people to spend more money, increasing inflation rates throughout the world. So one thing that the Bank of Canada can do is to make it harder for people to spend money. And so one thing they can do is to increase interest rates, making it harder to borrow money and incentivize people to keep their money in a savings account. When borrowing money becomes more expensive and interest rates at banks become higher, then people spend less and then inflation rates tend to go down. Here is the historical Bank of Canada interest rates. You can see from 2010 to basically 2018, interest rates were very low, very, very low. In fact, a lot lower than historical averages. And then when COVID hit, you can see it went down to 0.5% there. And then lately, the interest rates went up, starting in 2022 to try to control inflation as inflation reached 9-10% for a short period. The Bank of Canada has a target for inflation to be between 1 and 3%, and 2% being the ultimate goal for the Bank of Canada. And inflation numbers came in at 1.6% in October of 2024. This led to a significant cut. You can see here that the Bank of Canada meets 8 times per year, and they discuss whether to increase or decrease interest rates. And you can see in 2023, they were still increasing rates, and then they held at 5% for a few months. And when inflation started to show signs of being in control, then the Bank of Canada started to lower those interest rates. And you can see that when inflation numbers got below 2%, that the Bank of Canada actually took a significant chunk out of it at 0.5% or 50 basis points. And that's a big jump, as the normal increase and decrease is at 25 basis points or 0.25% each time. So let's talk about who this benefits and who this doesn't benefit. So obviously, if you have a variable rate mortgage, this is very good news for you. Variable rate mortgages are tied to bank prime rates, and bank prime rates go up and down with the Bank of Canada rates. And you will see that bank prime rates will go down generally the day after the announcement from the Bank of Canada. Bank prime rates are generally between 1.5 and 2% higher than the Bank of Canada rates. And so when the Bank of Canada lowered the rate 0.5%, the day after that announcement, bank prime rates each followed suit and lowered their bank prime rates by 0.5%. This allowed variable rate mortgages to go down 0.5% generally as well. So if you have a variable rate mortgage, then you're very happy with the interest rates falling. If you have a fixed rate mortgage, you're unaffected by this, as you're locked in for a certain time frame, generally 5-year term or something like that. But if you are renewing, or you are a first-time home buyer and you're just looking for a mortgage, you will notice that fixed rates have come down sort of in step with the Bank of Canada announcements. Fixed rate mortgages, however, are tied to bond yields, not the Bank of Canada rates. So indirectly, they are being affected, because as the Bank of Canada announces rates decreasing, generally bond yields also tend to go down. Not always, but it is indirectly tied to it. So you will have noticed that fixed rate mortgages have fallen a little because bond yields have decreased. So if you do invest in bonds for their yields, this is not good news for you. You want higher interest rates, so your bond yields do stay high. However, on the flip side, as the Bank of Canada lowers their interest rate, bond values tend to go up. bonds can get a little complicated at times. Essentially, if I bought a bond with a yield of 5% and now interest rates are dropping, so the yields are dropping on bonds, but I have that bond worth 5%, people think my bond is more valuable because they can only get a bond with a yield of 4%, but I have a bond worth 5%. So if I have a tradable bond, people will want to buy my bond for more money than I purchased it with. I know that can get a little complicated and hard to keep up with. Maybe I'll have a video discussing bonds in general. But essentially what you need to know right now is that as interest rates go down, then bond yields also go down, but bond values do go up. Other items to put in the good column for dropping interest rates is if you are a holder of a loan or line of credit, and that includes student loans and car loans, anything like that. Anything tied to a variable rate will go down as well. These loans, student loans, car loans, lines of credit, are generally tied to bank prime rates as well. So again, as Bank of Canada lowers their rates, bank prime rates go down, so your interest on your student loans and your car loans and your lines of credit will all go down as well. However, not so good for savers. So if you have a high interest savings account, you will have noticed that interest rates are starting to drop. I know I got an email from EQ Bank, Wealthsimple, and Neo Financial. They all told me that they're going to drop their interest rates. EQ Bank and Wealthsimple have been following suit along with the Bank of Canada announcements. So every time they dropped, I got an email from EQ Bank and Wealthsimple. Neo Financial had held strong for a little while, but I did just get an announcement saying that they would drop their interest rates from 4% to 3%. So they dropped 1%. The other two banks have dropped 1.25% in step with the Bank of Canada's announcements. Along those same lines, if you invest in GICs for their safety, you hopefully locked in at a higher rate because those rates are also dropping. I know my boys bought 3-year GICs and they got an interest rate at 5%. You can see here through EQ Bank's website that you can no longer get a GIC rate for 5%. It's dropped basically in step with the Bank of Canada's announcements as well. So if you do like the safety of the GICs, this won't be good news for you. If you are like myself and my wife and have a defined benefit plan, if you are nearing retirement, you may have the option to commute your pension. And to commute your pension just means that you can take your pension as a lump sum rather than monthly pension payouts. I know if I retire before 55, then I have the option to commute my pension. And I know what the value of my commuted pension is because in my annual net worth, I use the commuted value of my pension to determine how valuable that pension is in my spreadsheets. And as interest rates increased, my commuted value of my pension decreased quite significantly. In fact, the commuted value of my pension isn't even near what it used to be 4 or 5 years ago, and I've put 4 or 5 years more into my pension, and I still haven't made back all the losses from the increased interest rates. So pre-COVID, when interest rates were very, very low, it was almost a no-brainer that if you were able to commute your pension, you would take the commuted value of your pension. And as interest rates did increase, it became a no-brainer basically to not commute your pension, to take the monthly lump sums. So if you are near retirement and you have the option to commute, then you may have your eye on what interest rates are doing because it may determine whether you commute or you take your monthly pension. At the same time, if you don't have a pension at your work, then you may be inclined to look at an annuity to create your own pension. And as interest rates are falling, it becomes less and less appealing to get an annuity. So I'm just going to make up some numbers. Let's say you bought an annuity for $100,000 that pays, I don't know, like $1,000 per month for the rest of your life when interest rates peaked. Now, for $100,000, you may only get that same annuity for, say, $750 per month. So as interest rates decline, then so does the annuity payouts as well. Hopefully, if you are looking at an annuity, hopefully you purchased at the peak so you could get those higher payouts. If you rely on dividends or are a dividend investor, lower interest rates will probably benefit you as well. Not because dividends are increasing, but dividend paying stocks will often increase. So as people look for safety and savings accounts are lowering their interest rates, GICs are lowering their interest rates, then people look to dividend paying companies to get their fixed income. And because they're not getting that safety from the savings accounts and GICs, they put more money into the dividend paying stocks, increasing the value of dividend paying stocks, which is really nice if you hold those companies. As a whole, the stock market tends to generally ignore increase and decrease in Bank of Canada's rates, or even the Fed down in the US. As I was researching this, there was not much correlation between where the market was and what it was doing compared to what interest rates are doing. The best correlation I could find was that if banks around the world were lowering their interest rates because a recession came, once there was a recession, then the stock markets did crash. It was affected by that, but it wasn't really because of the falling interest rates. It was more because of the recession. So really, the stock market as a whole isn't really tied very tightly to the interest rate decisions. So in general, if you are a borrower, if you've got loans and lines of credit and mortgage, you will be happy by these announcements with the interest rates falling. If you are a saver, then you are not happy because all your interest rates are going down and you're saving less in your bank. If you're an investor, generally it doesn't really matter. So I hope this video has shown you who is being affected by some of these interest rates and how you might be affected by these interest rates. And if you're interested in more of these videos, please subscribe below and have a wonderful day.